Good afternoon, everybody. Now, welcome to the GenZero Climate Summit. I'm really honored to be kicking off the next few days with my distinguished panelists, who truly are some of the most effective and well-regarded advocates for climate action and carbon markets today. So Ambassador Ravi, Special Representative Rachel, and Tom, I think they represent not just the institutions they work for today, but also a collective wisdom, right, gathered from decades of experience in public policy and finance. So I'm sure we're all looking forward to a wide-ranging discussion across many topics today. So I have a long list of topics that I want to get through, but of course, members of the audience, please also feel free to ask your questions on Slido. They flashed that earlier. So without further ado, let's get started. Okay, I think it would be remiss of us not to spend at least 10 minutes talking about the current context and environment that we are currently operating in. So maybe the first question to Ravi, and Rachel, do feel free to chime in as well. So do you see a risk of global recession triggered by all the concerns around trade, and do you see that impacting climate investments? And then the second part of the question, just because that wasn't hard enough, right? What do you think countries like Singapore, and Rachel, maybe the UK as well, can do to still meet our climate commitments amidst all of these uncertainties?
Thank you, Kimberly, and great to be here. As a former central banker, one thing I've learned is never to predict recessions or inflations, at least in public. So I'm not going to say if there's going to be a recession, but the ongoing tariff wars or trade wars, as some would call it, still being played out. Recession or not, I think they're going to affect the climate agenda in a couple of ways. One, tariffs by their nature are going to unleash stagflationary pressures. Lower growth, higher inflation. How high in inflation, how low the growth? Well, I can't tell. But I think directionally, that's quite a safe assumption to make. If this persists, and all signs are that we are heading towards higher prices and lower growth. What does that mean? It means governments are going to be strapped. Fiscal resources would have to be diverted towards supporting the economy. Higher prices obviously mean climate commitments are going to have to compete against many other objectives. Now, it's not just the trade issues. I think the geopolitics is also going to divert resources. The ongoing conflict in the Ukraine, the questions about US security blanket for Europe, I think will mean countries having to step up more on the defense expenditures and so on. So all this in aggregate is going to have an impact, no question about it. Second, more specifically, tariffs have a way of disrupting supply chains in ways that most of us cannot foretell beforehand. It's only when it happens then you realize COVID-19 taught us that. Yeah. And I think we're going to see the same thing now. The supply chains for batteries, for parts of electric vehicles, for solar panels, so wind turbines, a whole range of things that thankfully have plummeted in prices and is driving a surge in renewable energy and electrification of transport. I worry about how that's going to be affected because where these parts come from and what restrictions they're subject to is going to have an impact. 2/3 of the value of the lithium-ion batteries imported into the United States comes from China. So I'm not sure how that's going to be impacted and what the knock-on effects are going to be on the rest of the world. So that's just one small example. So that's the second thing, tariffs and supply chains. The third, the general mood, political mood, not just in the United States, in parts of Europe, in Asia, has shifted. Cost of living considerations are paramount, and you see this in many elections. And business uncertainties are weighing down on businesses. So again, there's likely to be a flagging of interest. Not that people don't care about the climate, it just has to compete with other very pressing priorities. Be that as it may, what does it mean? How should countries respond to this? Singapore, more than most countries, small, open, really subject to the vagaries of international trade flows, investment flows. So we will be affected. This will be a very challenging period. But every morning we read the news coming out of politics and businesses, the most important news is the news that's coming out of nature. And that's usually in the back pages or somewhere hidden. The planet continues to deteriorate. Climate change is accelerating. And whatever the vicissitudes of politics and economics, nature's signals are very clear. The temperatures are rising, and a whole cascade of, again, unpredictable climate events are going to be unfolding. And so our position is that this is a reality out in the future that we have to deal with. And that's why our commitments remain. We're one of the few countries that filed our NDCs on time, and we are looking to reduce our emissions. At the lower end of the range for 2035, we'll be on a straight line path towards net zero. And we are dead serious, drawing up plans, transition plans, sector by sector, working with businesses to do this. Because whether we like it or not, we need to be prepared for a low carbon, climate impaired world. Eventually, the world will have to respond. It will be a disorderly transition. Better to be ahead of the game, better to start adjusting slowly but surely, step by step, so that when it comes, we are ready for a low carbon world. And it's also going to be a climate impact world. So building up resilience, investing in resilience is also important. So that's been our approach. Right. And I think more and more countries will start doing that. You need to fight the short-term battles, trade restrictions, economic slowdown, other pressing priorities. But there's no alternative. You've got to keep investing in the future, in capabilities. Short term, you can be tactical about certain costs. You may not want to incur excessive costs when other costs are going up. But there is no alternative to investing in capabilities for a future that is already being set today.
Understood. No, thank you, Ravi. So policymakers have to listen to nature. Listen to what nature is telling you and ignore the noise and what you're seeing in the news quite as much. And so maybe the next question to Tom, because I think Ambassador Ravi spoke about this as well, just about how global supply chains are under strain, right? And so you talk to a lot of corporates, right? You try to sell them carbon, right? And they're actually seeing a lot of pressures on their P&L, right? Potential pressures, maybe pressures not quite yet. Right. So do you think that climate and carbon will take a back seat? Or do you think that the commitment remains and it's just about how they actually get there?
Well, the commitment remains, but it's in the back of the minivan right now. So it's gone from the second row to the, right. Or maybe even the next to the driver to the back of the van. And it's kind of obvious. It's largely a voluntary market. Your goals are in 2050. And so you're saying, oh, what's a couple of years? And I started in this aspect of my career in beginning 2023, and it's basically been a bad market since then. So it didn't really happen because of the trade discussions. It happened because of many things, but they've put it in the back burner largely because, and part of it's our fault, because we haven't really said what's good and what's bad. The standards Mandy talked about are changing all the time, one. Two, do offsets count, do they not count? Right. If I do it, I'm going to be called out in the press or not called out in the press. It almost felt better not to put your head up than to put your head up. And so a lot of people have done that. If you even look at like the first quarter of this year, if you look at how many retirements there were like in North America, I think it was 23 companies were 80% of the retirements of credits, of public credits, of what we know of public credits. Only 118 had any retirements. If you look at the world, it was 53 companies were 80% of the credits. So it's pretty staggering how concentrated it is right now because people are really waiting. And most of those people that aren't doing it have goals. And they want to meet those goals, but they haven't. There's over 1 billion credits outstanding right now that haven't been retired, for all I know, maybe even bought yet, that Vera and others have issued over the years. So there's a huge overhang. There's changing of standards, and people are kind of waiting for direction in that. In the financial markets, when things got this bad, you had the government step in and provide, the Fed came in or whoever came in and provided liquidity, whatever. But this market has to find its own way, and we're hopeful that it will find its own way because we think it is the answer to a lot of the problems that are going on, but it's struggling.
Understood. No, and Rachel, I think so much of what Tom is saying is just about the absence of regulation, right? And I think putting aside the regulation of the carbon markets, if we just start from domestic country policies, right, just around the climate policies that they have, and Ambassador Ravi spoke about how many countries missed the deadline for the submissions of the latest climate pledges. Maybe tell us a little bit more about the trade-offs that countries have to think about, right, when they're setting their own climate pledges in terms of balancing climate ambition, but at the same time being very mindful also about economic pressures for their countries. I think I'd love to hear your thoughts on that.
So it's 10 years from the Paris Agreement, and this is the sort of third generation of NDCs, right? Initial, first, second.
Yeah.
And so, so first of all, we came out with our NDC in November early to try to sort of encourage others to do the same. 81% reduction over the baseline levels. An ambitious NDC, we admit that, but the point, not unrealistic completely. And so it's set there to stretch ourselves, right? Because we need to drive a change. But I think that going back to the Paris Agreement, like, first of all, the Paris Agreement would not have been possible if the business and finance sector didn't say to politicians, look, come with ambition and we'll meet you there and we will deliver together with you. And that message to negotiators and policymakers was really, really important. And then what happened is everybody went away and we had all kinds of voluntary clubs, you know, asset owners, asset managers, banks, everybody. We had voluntary initiatives setting up in the voluntary market. We had voluntary initiatives for transparency, I mean, you name it, right? And governments were sort of like, oh, we went to Paris and we did the deal. It's like, no. Article 2.1c of Paris says your entire economy now needs to be managed to meet the ambition of the Paris Agreement. And that's one of the bits, right, in hindsight, that all economies, like nobody's perfect here, everybody sort of let go a little bit. So now we're paying the price, right? So we're paying the price of now in this very uncertain, blustery world of tariff wars and a politicization, different ends of the political spectrum of just the even concept of net zero, which gives you less political space in some countries around the world. Now we have to get going. And so now what you're really looking for is economic planning, social, commitments that will allow us to understand that, climate isn't something in a silo over here, and then the economy is being managed over here. That these things are together, and I think the strive for resilience is where this really comes home, because, the kinds of impacts and the kinds of degradation of GDP growth in all economies around the world, the insurance industry pulling back as it sort of witnesses and is impacted by the kinds of climate events we're having. And that's ignoring the sort of uninsured assets in most emerging markets, developing economies. These things they're coming home to roost. They're coming home to roost on the public balance sheet. So what does that mean now? We only have 20 countries that came in on time with the NDCs. For a lot of countries, I think with the geopolitics, then, under-promising and over-delivering is a pragmatic political choice. I don't think that necessarily is a bad thing at this particular sort of moment of crisis geopolitically, but if everybody sort of takes that message and we see a sort of air being let out of the tires in terms of ambition and pace of change, then it becomes a problem. So I'm hoping that by the time we get to November, we have a sufficient number of countries that understand the signal effect of the NDCs to their own economies and to the private sector as well as everybody else. But just my final point on this is that multilateralism, right, is fraying at the edges a little bit. We've been saying for years, since Indonesia led the G20 and then India and then Brazil and now South Africa, that the international system is not fit for purpose for this particular crisis at this particular time. While we get that sorted out, which might appear difficult at the moment, you're seeing coalitions of the working getting on with it, and that's why we're working with Singapore on voluntary carbon markets and others. Right, there is a lot that we can do to send a signal amidst the noise that will start to hopefully meet some of the problems that Tom is describing.
Thank you, Rachel, because And it's interesting that governments are leaning in to send these signals that you're building coalitions, because at the same time, if you think about the private sector financial coalitions, I think there has been some sort of withdrawal. So, and I think going back to Tom as well, and Ambassador Ravi, please do feel free to chime in as well. Do you think that this will really impact the flow of of capital into climate, just because of all this noise and concerns just around how financial institutions are being perceived?
No, well, no. I don't really think so. I mean, one thing I want to add is that I think this time for the first time, if you look at the retirements in the first quarter, more were private than public. The fact that this is a voluntary market and you want to hide what you're doing, just look at the kind of bad environment it is for doing these kind of things. I think for the financial institutions, at least the ones I'm familiar with, a lot of pulling out wasn't because they're reducing what they think, but it was too confusing. There was too many different things that had grown up over the years. Yeah. I think the European directives, what they had to fill out, they felt that was doing a lot of the work that they were heretofore doing in a committee or in some other place, and so they just wanted to simplify their lives, so to speak, to do that. But the banks help raise money, but they're not really the guys that are financing it, right? And so most of the equity that's coming in is not from a bank. In fact, we've never had a bank involved in one of our transactions, and they're not trading, because if you look back at what I said about retirements, around 55 million were retired, 55 million credits in the first quarter. If you generously said that was $10 a credit, that means $500 million. That's nothing. And these guys are used to huge markets and trading and all that. You're going to need the banks for liquidity in the future when this is the market it can be. But right now, you don't need them for that. They're still actively involved in buying. They're still actively involved in blended finance and things like that. And also, most banks don't lend. We're doing a project. These are 50, 60-year projects. Banks, if the regulators don't come in and say, hey, I'm glad you're doing this 50-year loan. That's not how it really works. And so you need to bring in. There's lots of pockets of money, however, that the banks help you source, be it insurance money, pension money, infrastructure funds, and the like that can help do that. So I'm not really worried about that.
And I think that's why we also believe here at GenZero that carbon markets, right, are going to be so critical for really helping to scale and in the first place, catalyze capital, right, into deserving technological solutions and also deserving nature solutions. But I think if you look at carbon markets today, right, versus what successful and well-functioning capital markets are, and you pick any capital market, right, the bond market or something, what do you think are key features in the financial markets that we desperately need in carbon markets? And what can we do to get there? Maybe I'll start with you, Ambassador Ravi.
Yeah. So I just wanted to quickly also add and reinforce what Tom said. All my conversations that I've had with financial institutions and businesses, I think underscores the message. They are not changing their long-term targets or their commitment to sustainability, because what I just said earlier on, if this is the future, they need to be prepared for it.
Yes.
I think what many of them are doing, given the current climate, is not to use the word climate too much. And I think that's wise. I think you want to do these things without making a big fanfare of it. And if you look at, say, GFANZ, which has been, like Rachel said, was at the vanguard of this, getting financial institutions to commit to net zero by 2050, and in a sense, pressurizing governments to do more. So GFANZ is stepping back from policy advocacy. A lot of the work has been done. Maybe that's not an area that you want to focus on. And so the focus has shifted to actually getting down to the nuts and bolts of financing transition. And I think that is a necessary step. So it is not bad that it is happening that way. And others I speak to too on carbon markets say the same thing. So I think what is happening is financial institutions and businesses are buckling down to the brass tacks issues of how to do these things. Tom mentioned blended finance. So that was a buzzword 2-3 years ago. People are now realizing there's a lot more work that needs to be done in blended finance. It's not just about bringing catalytic capital from private and catalytic capital from public and philanthropic sources, combining with private capital. You need to bring in technical assistance, project development expertise, regulatory certainties, and so on. It's a whole package. That is really blending. It's not just the finance that's being blended, but it's a blending of many policies and many parts of the ecosystem coming together. And then you need asset managers, because the bank's balance sheets are not going to be able to sustain this. They need to recycle the capital. So you need to bring asset managers into the picture, securitize these loans, and have it offloaded, which means they need to be in a form and structured in a form that asset managers would buy. So increasingly, I think the realization is dawning that we need to take an ecosystem approach. And now coming to carbon markets, that's also the case. This market has grown quite organically, and I think quite admirably, given the lack of any central direction in this. And it has also now fallen into bad times with a fair number of abuses in the markets, and I think quite rightly so being pointed out. And now there's a general erosion of confidence of the last 2 years. But if I look at conversations in the last 6 months to 8 months, the mood has shifted again. People are now saying, yep, they didn't work well, there have been abuses, and we need to be watchful, but we need to make this market work. It's just like blended finance. Very difficult to do, but you got to make it work. So carbon markets, very difficult to do, lots of integrity issues, but we got to make it work. You can't throw the baby out with the bathwater. And I think if you draw an analogy from financial markets, we need to address supply-side integrity. 2, you need to address demand-side legitimacy. And 3, you need to address infrastructure efficiency. And 4, some form of regulatory clarity. I mean, these are all the building blocks of a vibrant carbon market ecosystem. I think on the supply side, there's been good progress. The work of ICVCM has really spelled out clearly what a high-integrity carbon credit is. Now, a large chunk of the credits out there still don't meet that standard, but at least people are now more discerning. It has not translated into a price differential yet, but eventually, when prices reflect differences in quality, that's when the market takes off. That's what happens in finance. Finance is all about allocating capital according to risk. And so I think we're beginning to see that, but we need some more ways to go. But I think on the supply side, good progress is being made. On the demand side, we need to legitimize the purchase of credits. And this is something that Singapore and the UK have been working very closely together with other sovereigns to give some kind of guidance to corporates. Under what circumstances is it legitimate to buy credits? To give them confidence, clarity. And they are asking for it. Many of them do want to buy credits, but because of the bad press that credits have attracted, they want some air cover. And I think it's a legitimate role for governments to step in and set high but reasonable standards for what constitutes legitimate purposes. Infrastructure, I think we have a lot of issues to solve. The registries, the consistency of the data, and there are efforts at putting together data platforms so that you can compare, you have knowledge of what the different projects are about. There is discussion about price transparency so that you know what the prices, last transacted prices are. All these are par for the course in financial markets. And if you want to make credits like an asset that people can own and trade, they need to be of high quality, and there is a disclosure regime around it. So these are legitimate discussions that are beginning to take place, and some form of regulatory clarity, the legal status of a credit. So some of that work is still far out. There are discussions, but I think on the core issues of demand and supply, we're making some good progress, and I am hopeful that the voluntary carbon market, which is today about 2 billion, will start growing in the coming years. It needs to, because it is a vital tool of financing for decarbonization.
And Tom?
Yeah, just a couple points, and those are all great points. One is, I keep thinking there needs to be the time value of carbon. I don't understand why a carbon ton today, if I do it today, has the same value as one in 10 years. Yeah. And our scientists go through these projects and they get upset when it's 10% off or 15% off, and I'm saying, well, the time value difference is enormous. Yeah. And so, but we have no time value. You do it in 2045 or do it today, you get the same credit. It doesn't make any sense. And so, because there's no science in that, to me, it underscores everything that we're doing. And where's the science in that kind of one?
And that's something in financial markets that you don't have in carbon. Because actually, you have different tenured bonds, but here, It's just 1 ton.
Right.
The people have estimated how much carbon more is, because you're not compounding the effect of the carbon. One today is worth a lot more, but we don't give them the credit for it being more. So you're not even incentivized to do it now versus before. So I just think that's a big aspect. Also, people treat this mostly as procurement and philanthropy, not as a financial instrument. So, and I saw Scott O'Malley here from the ISDA, he talked, it's like the beginning of the derivative markets, when derivative people got together and developed standards and payment terms and all those things, so that you can have some kind of ability to have assignability and fungibility among things, and there isn't any. And the last thing I would say, you need one standard. You need standards, like FASB is a standard for accounting or international accounting, and you work from that in analyzing the projects. Instead, now we have many standards, and everybody has their own standard. Even companies have their own standards. So it's really difficult to make them fungible in that way.
Well, thank you. And Rachel, just going on this financial markets thing analogy a little bit further. So if you think about the UNFCCC then, it's almost like, I don't know, Basel for banks or the IMF and the World Bank for oversight, right? So what do you think really are the strengths and limitations, right, of the UNFCCC? And what do you think is really needed to operationalize Article 6, which will be actually, very momentous for carbon?
Well, I mean, I think that there's an extraordinary amount of Article 6.2 activity going on. And so the question really is that how do we sort of build a more trustworthy path towards, a global at-scale effective carbon market? So I think there's no secret that there are parts of the sort of climate community that don't believe that markets provide perhaps the solution that's necessary. I think that that's entirely disrespectful of the stewards of nature and the women, that would benefit from receiving the flows of finance from carbon for changes in their behaviour, etc. I think that's a policy wonk conversation that happens in some parts of the world, talking about other people in the world. I think most people on low incomes, most people stewarding nature make very sophisticated financial decisions every minute of every day because they're living with scarcity. And so I think if we throw away some of that and with humility try to start building high integrity voluntary markets, as well as operate Article 6, as well as help countries build compliance markets where that's what they want to do, you'll start to see a sophistication and a growth. The real problem that we've had up to now is that we haven't delineated what is the transition pathway for a firm in a sector of the economy. So if you're in petrochemicals, you're going to need access to carbon markets because your transition pathway looks like one thing, where for food and agriculture, or food and agribusiness, it might look differently. For a financial company, it might look differently again. And we sort of talked about the transition in totally global terms without the delineation of exactly what would you expect from the petrochemicals industry or shipping between now and 2030 and 2030 and 25. Now, I think now we're starting to have transition pathways. We're starting to understand. Now, governments can help, as Ravi said, by sending a signal that we would expect you to be able to, on the basis of a transition pathway which is based on science and makes economic sense, we would expect you to then access, and we would want you to access the carbon markets with integrity in order to speed your transition. Now, the question is, the UN then has, I think, a norm-setting role. The UN is not a market regulator, but it has a norm-setting role, and it has to help build confidence that this time we're going to sort of stay within the sort of guardrails of integrity and do this right. So ICVCM's done great work. The problem is stimulating demand, and that's about sending a signal to the private sector all around the world that this will happen. And then prices will start to emerge. Yeah. And then you'll start to get secondary markets and derivative products and all the rest of it, all of that sophistication. But at the moment, we have to have supply, we have to have demand, and we have to have prices emerging, which are appropriate to the scale of the challenge. The UN is the norm-setting agency.
Right, thank you for that. And I think you touched on the role that governments have to play, right, in determining integrity. And I think Singapore has tried to do quite a lot on this front, right? I mean, you've introduced international carbon credit ICC framework, which sets out clear standards of eligibility. And this is not an easy task because whoever you say is legitimate will be thought of as legitimate, and whoever else you say is not, or even if you don't say that they're not, if they don't get that stamp, then that could have bearings on them as well. So how do you take that role and balance the need to actually be very strict when it comes to integrity, while still also maintaining a range of options for decarbonization, right? It's a tricky thing.
It is. As with all things in life, aren't they all trade-offs? Almost like parenting, isn't it?
Yes.
Okay, you resonate with that.
Yeah.
I think the approach should be to set high standards. There's no alternative to high standards, but set reasonable high standards, standards that can, with good effort, be attained. I think the easiest thing to do, and this applies to all kinds of regulation, is if you want absolute certainty and risk aversion, set ridiculously high standards that nobody can meet and nothing will be done. That should not be the intention here. We want a thriving carbon market. But at the same time, we cannot set low standards to generate demand and supply. So it is a fine balance, and that's what we've been trying to do. So we've come out with a white list. We've laid out how the Article 6 translates into our environmental integrity standards for Singapore as a sovereign buyer, right, to meet our NDC requirements. But we are also, the latest RFP that we put out was for nature-based credits. And we specified the standards. And we also said, now, if you have other ways in which you can meet these standards, we can consider. And that's the approach. You got to start piloting some of this and say, there's an existing standard. If you can meet that, you refer to that, fine. But if you can't, but you have other ways in which you can reach not the standard, but the underlying intent and desired outcome that meets our requirements, let's discuss. And I think that's the conversation we want to have. Another example, coal phase-out credits. Now, coal is a dirty word in many climate circles, and some would not touch coal to finance it. But the reality is that 1 out of 6 tons of emissions up in the atmosphere going up every day comes from a coal-fired power plant in Asia. Average age 15 years, they've got another 30 years to run, and if they run their full lives, economic lives, backed by very powerful, tight power purchase agreements, you're going to exhaust 2/3 of the remaining carbon budget for 1.5. And that means we're all heading into catastrophic climate change. So you got to find a way to phase out coal in a credible fashion, generate credits, because this is where the credits will come in. Because what economic incentive is there for them to retire the coal plants 10, 15, 20 years earlier? You got to generate credits. That is the additionality, because otherwise these plants will be spewing CO2. So you got to bring that forward. But we know the great challenges involved in that, the leakage risks, carbon leakage risks, coal-fired power plants being refired in other parts of the grid, all kinds of things. And you need to make sure that this is replaced by renewables. Otherwise, 2-3 years down the road, you can't meet demand. The coal plant comes back up again. Problems. Does that mean we don't do anything about it? No. It means you have to put guardrails and safeguards and specify the requirements in a tight manner. And this is what the Traction Coalition has done. And they've put out the final guidance, which I think is a good convergence across 30 players in the carbon market ecosystem. 2 years it took us to get to that place. And today we put that out. It includes just transition for the coal mining, mining communities. It includes the requirements for renewable energy. It also specifies the balance to be struck between asset-based decarbonization and a sectoral or jurisdiction-based approach. All these are fine balances to be struck. And Singapore government has said, if the final credits, depending on the projects, meet our environmental standards, we will buy them. And we're trying to build a coalition of support, corporates and sovereigns, to say, we are prepared to buy these coal phase-out credits if they meet our high standards, but not to reject out of hand anything to do with coal, because that, I think, is going to set back the climate agenda. Yes. The same thing we need to do for nature-based. Very hard to do. How do you know the tree will be there 30 years' time? You don't. But you've got to find a way to design credits that will actually give the assurance, indeed, that is the case. So that's our next thing that we need to work on. So step by step, we've got to start tackling these problems systematically, avoid binary outcomes, find reasonable positions, and the most important thing for carbon markets, don't let the perfect be the enemy of the good. Yeah. A CO2 ton removed today is worth more than being removed in 2040. So let's get down to it. And credits can show us how.
Thank you for that, Ravi, because actually it's interesting that you talk about how the Singapore government is willing to take this very pragmatic view while not compromising on standards and integrity. Because if we think about some of the other positions taken by big tech buyers, for instance, specifically on coal, right, or even other reduction credits, I think there's an only removals sort of approach. And I wonder how, Tom, how do you feel about that? Do you feel that increasingly we run the risk of a certain hegemony of views as it relates to carbon? Especially when you think about how, like you mentioned earlier, so much of the buying and the demand is consolidated and concentrated versus the developers today.
Well, thank God for the tech companies, actually.
Yeah, to be fair.
So, they're really keeping the market alive in what they're doing. I always love the fact that here's the people that are doing AI, which have all the knowledge of the world, and they're buying carbon credits. Like everybody that isn't does not have their knowledge, and they're taking the risk of, and one of the reasons they went to removal, of course, was the risk of them. They didn't want to be in the risk area of, is this avoidance, is it not, be in that public debate. I think if that wasn't as public of a debate, they would be happy to be in other sectors. But they went to removals, I think, largely to get away from that kind of noise going forward. Also, there's really, they're the large voice inside of this, but I like their voice also because there's really three big voices. There's the voice of climate deniers, right? There's the voice of people that think we shouldn't be doing offsets, so we should only be doing insets. And they're the voice of the people that believe in offsets. So I like the weight of them in this field because I think they can help lead the way, just like Singapore is leading the way, by the way. And so I think it's great that they're doing this and pushing forward. They have their own standards because you kind of can't wait for new standards to come up. You have to believe in your own standards and that you're buying something good, and that's what they do. So they stand with the standard they want to have in what they do. They're pretty forward with those standards. You can read about them if you want to read about them, and then they execute on that. So I think it's good.
I think we need to get over some of these false dichotomies that have crept into the carbon market space. You must all have read George Orwell's Animal Farm, right? 4 legs good, 2 legs bad. We have that version in the carbon markets. Compliance is good, voluntary is bad. Removal is good, reduction is bad. Vintage also good and bad, recent versus long vintage. These are oversimplifications. What really matters is, are you sure you've removed or reduced 1 ton of CO2 as per the credit says? That is where we should focus, that final outcome. And the labels that we put to these things, I think, are less important. And I think the more we can take a data-based approach to defining what is a good credit, then I think we can get over some of these false dichotomies and get on moving.
No, thank you for that. I'm mindful of time, and I promised the audience that I would let them ask some questions. So I think we can pull up one of the questions submitted on Slido. And I think this will be a nice one for us to think about wrapping up as well. And I think maybe for Rachel, thinking about everything that's happening today, right? What do you think will be your key goal for COP30, right? And what do you think will be the key challenges and the potential hot button topics?
Well, I think how we, given that this is an Amazon COP,
yes,
one of the key challenges is breaking through the ability to in a purposeful, high integrity carbon market, get finance flowing into nature. I mean, I understand, I mean, I think you're right, thank God for big tech, but they're going to the safe removals.
Yes.
And we've got to get to the point where we've got confidence in the high integrity supply side standards so that this finance starts flowing, because you know, we've got to retire coal. We've got to help economies dependent on coal transition away from that as much as possible. And we've got to stop cutting down trees and playing with the landscape in tropical zones in particular. So key goals for COP30. One is that we sort of break through, and I think the work that Singapore and the UK are doing with Kenya and others is about, by the time we get to COP30, really being able to move some confidence on the demand side of the market. Secondly, we had a sort of abortive attempt to talk about climate finance at the last COP. And we've made clear that there is a certain amount of public money under the old strictures of common but differentiated responsibility, which is supposed to be designed to leverage an awful lot more private investment, new flows through carbon markets, etc. Most climate negotiators and most members of the general public and most policymakers have no idea what that means. And so a roadmap from Baku to Belém that shows you how you can actually start to build the kinds of investment flows that we need will be really important. Thirdly, we have to talk about how we're going to fund resilience. Resilience is not a number in a negotiation in a climate convention of a certain amount of public money that is somehow going to make everybody safe. Resilience comes from our investment in people. We know how to help people become resilient. We know a lot about conditional cash transfers and social safety nets and microinsurance at scale coming out of investments made by Singaporean funds. So we know how to make the landscape resilient, and we know how to make economic activity resilient. And that's about how we manage our economies. It's not just about a number in a climate negotiation. So if we could start to make progress on these really hard things, but it is, as the Brazilians will tell you, a COP about implementation. So then it's about transition plans. It's about energy transition plans in countries which would allow you to have faith that they will regulate their energy transition in a way that we can do coal retirement credits without meeting the jeopardies of the past. But the final thing I'd say is that the global economy today is awash with subsidies. Harmful subsidies for fossil fuel industry, which is why people are a little bit reticent to believe we can get this right. Ravi and I are going to prove them wrong. But also awash with harmful food subsidies as well. So the economy is not a level playing field. It is stacked against us. And that's why governments have really got to start stepping in.
Ravi, any last thoughts? Ravi, any last thoughts in terms of what you want to achieve from COP?
Well, Rita's covered it very well. I think the two key levers, I mean, if you talk about climate finance, I think there are three dimensions. A lot of the attention is focused on what the advanced economies will provide for the developing countries, and now we've got a number 300 billion. Yeah. That discussion will be ongoing. Yes, I do think the advanced economies need to do more, but I think these debates somehow miss the point. They can probably do a bit more, but they're also facing fiscal deficits and water frustrations and so on. They're not going to be able to raise the kind of money that is required for the transition in the emerging world or the global south. They can do a bit more, but that is not going to be the answer. The answer has to be how to make the 300 billion or 500 billion, whatever the number is, work harder, work much more effectively. And this is where blended finance comes in. If that money can be used to crowd in 5 times of private capital, and you apply intelligence to design programs that enable that to happen, then you can address the needs of the global south. I think that is an important discussion that needs to be had, how to leverage off what the richer countries are providing to draw in private capital. And the other thing is, and this is one of the ironies of the way NDCs are done, $1 spent in the global south vis-a-vis $1 spent in the advanced economies. $1 spent in the global south reduces emissions by 30% more than in the industrial economies. And you can figure out why, because those are the lower hanging fruits. So actually it makes more sense if you want to reduce total emissions in the atmosphere for your own good, you should be deploying your capital together with private capital in a third world country and achieve much sharper reductions. This is not to say that you don't have to reduce your emissions, but in terms of marginal benefits and effectiveness, that's something to be looked at. So carbon markets, and blended finance are the two key levers for unlocking private capital, and they need to be part of the larger discussion about the climate finance agenda, the road to Belém, and so on. And transition planning is a very important thing. Many financial institutions are not able to reach their 2030 targets or are reviewing their targets, not because their own commitment is flagging. Because ultimately financed emissions depend on the real economy. It's their clients' transition plans. And they're realizing they need to work much closer with the clients to develop robust transition plans. A final word on NDCs, since that will come up also. NDCs are seen today as some kind of unpleasant international obligation that we're all kicking and screaming and putting there on our table and trying to reduce cost as much as possible. I think it misses the point that NDCs are an economic strategy for the future. The national transition plans that underlie these NDCs are really economic restructuring plans for the future. Same for companies. The credits you buy, the sustainability targets you set, they're not a CSR function. They are a business strategy. And you need to integrate climate commitments into core business, just as countries need to integrate their NDCs into their economic strategies for the future. And if you have more of that, then you have better alignment and more ambition and more progress. So transition planning is another key area that we hope will get a lot more traction in this, not only the coming COP, but also succeeding COPs.
No, thank you for that, Ravi. So I think we're out of time, but so thank you very much to my distinguished panelists. And I think if I sum it up, I think to overcome paralysis, it's really a mix of private sector, public sector, and international sort of action that we'll need to actually drive climate action forward. So thank you very much. Thank you.